Hi, welcome to Deloitte Financial Reporting Updates, our webcast series for issues and developments related to the various accounting frameworks. This presentation is Bringing Clarity to an IFRS World, IFRS Quarterly Technical Update. I'm John Kligman, your host for this webcast, and I'm joined by others from our national office. As you're aware, this webcast has been pre-recorded. It can be accessed at any time at www.deloitte.com/ca/update. So please let your colleagues know of its availability. Now on to our agenda. First, you'll hear from Julia Suk, who will discuss the Canadian Securities Administrators Continuous Disclosure Review Program. After Julia, Claire Grinley will provide an update on IFRS 15, revenue from contracts with customers, discuss the exposure draft on IAS 19 and IFRIC 14, and then provide an update on upcoming IASB projects. I'd like to remind our viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. I'd now like to welcome our speakers. Julia Suk is a Senior Manager within National Assurance and Advisory Services of Deloitte Canada. In this role, Julia is responsible for monitoring quality standards for Deloitte's public company client filings. Julia also provides consultative advice to attest and non-attest clients on general securities filings and financial reporting matters. In the past, Julia also completed a one-year secondment to the Ontario Securities Commission, working within the Office of the Chief Accountant. Claire Grinley is a partner in Deloitte's national office and is a member of both the Technical Consultations Group for the Canadian firm and Deloitte's IFRS leadership team. Subjects of focus for Claire include employee benefits, impairment, and joint arrangements, and she's also a member of the IFRS Discussion Group, or IDG, a subgroup of the Canadian Accounting Standards Board. Over to you, Julia.
Thanks, John. Hi, everyone. As traditionally done in the past, the CSA has reported on their annual staff notice on their Continuous Disclosure Review Program conducted throughout the year. Their fiscal year ends in March, so their report generally comes out mid-summer, and for this year, it was published July 16th. The Continuous Disclosure Review Program was established in 2004 by the staff of the CSA, for which the main goal was to improve the completeness, quality, and timeliness of the continuous disclosure provided by reporting issuers in Canada. It really aims to assess the compliance of the continuous disclosure documents filed by the reporting issuers and to help companies understand and comply with their obligations under the continuous disclosure rules so that the investors receive high quality disclosure. The Staff Notice 51344 consists of the main body of the report, which contains the summary of their findings, and then in the appendices, the CSA includes information about areas where common deficiencies were noted with examples to assist companies address the noted deficiencies and give some best practices where applicable. The current year results are shown on the slide here. In total, there were 1,058 reviews performed in total, where 580 of them were full reviews, and the rest were issue-oriented reviews, or IORs. This is a 7% increase in the number of reviews compared to the prior year, where the total was 991 reviews, with 221 of them being full reviews, and the rest were IORs. The bar graph at the bottom illustrates the results from this year. The CSA classifies the outcomes of the reviews into 5 categories, as done in the past. The first one is referred to enforcement, cease traded, or on the default list. Second is refilings required. Third, in the middle, is prospective changes that were made as a result of the reviews. Education and awareness, this is where there were enhancements that should be considered in its next filings that were discussed with the issuers, or the staff of the local jurisdictions ended up publishing staff notices and reported on a variety of continuous disclosure subject matters reflecting best practices and expectations. And of course, the last category being no actions required. This year, 59% of the outcomes required issuers to take some kind of action to improve or amend their disclosures in their filings, or resulted in the issuer being referred to enforcement, cease traded, or placed on the default list. The result in last year was 60%, which is comparable, although as you can tell from the graph, the distribution is somewhat different, with the more refilings being required this year than last. Just as a reminder, refilings are significant events that should be clearly and broadly disclosed to the marketplace in a timely manner. This appears to not always have happened, and when discussed, some issuers indicated that the delay was due to the fact that there were no scheduled audit committee meetings or board meetings where the news release could be approved and then waited for the next scheduled meeting. The CSA staff states in the report that this is not an appropriate reason, and the news release filings cannot be delayed for such reasons. They refer back to the requirements in NI 51-102, section 11.5, which requires that if the issuer decides it will refile a document under 51-102, and the information in the refiled document or restated financial information will differ materially from the information originally filed, the issuer must immediately issue and file a news release authorized by an executive officer disclosing the nature and substance of the change or proposed changes. This may involve audit committee approval or board member approval prior to their next scheduled meeting, and this is required because they need to provide timely news release as required. The CSA, when performing their full reviews, applies a risk-based approach for selecting reporting issuers. A full review is broader in scope than an IOR and covers many different types of disclosures, including selected issuers' most recent annual and interim financial statements, the management discussion and analysis filed before the start of the review. For all other continuous disclosure documents, the review covers a period of approximately 12 to 15 months. In certain cases, the scope of the review may be extended in order to cover prior periods. The issuer's continuous disclosure documents are monitored until the review is completed. A full review also includes an issuer's technical disclosure, such as technical reports for oil and gas and mining issuers, AIFs, annual reports, infocircs, news releases, material change reports, BARs, corporate websites, certifying officers' certifications, and material contracts. The selection for the IORs, or issue-oriented reviews, are based on targeted objective or subject matter of the review. An IOR focuses on a specific accounting, legal, or regulatory issue, and may focus on emerging issues, implementation of recent rules, or on matters where the staff believe there may be a heightened risk of investor harm. During this year, a total of 74% of all continuous disclosure reviews completed were IORs, compared to 78% last year. The categories shown on the graph to the right of in the slide are some of the IORs conducted by one or more jurisdictions. The other category, accounting for 16% of the total IORs this year, related to non-financial topics, which are MD&A topics, material change reports, REIT distributions, complaints, referrals, and other regulatory requirements. For the MD&A related findings, you can see on the slide here for the 6 main areas. The securities rules pertaining to the MD&A disclosures are given in National Instrument 51-102 Form 1 F1. Findings on liquidity and capital resources from the reviews related to issuers' failures in providing sufficient analysis. For example, issuers often reproduced information in their MD&A that was already provided in the financial statements, like a repeat of cash flow balances that come from operating, investing, and financial activities. Rather, the regulators are expecting to see much more focus on an issuer's ability to generate sufficient liquidity in the short and long term in order to fund planned growth, development activities, and expenditures necessary to maintain their capacity. Also, they're expecting to see an analysis of capital resources, including the amount, nature, and purpose of the commitments and expected sources of funds to meet these commitments. The CSA staff emphasized this information is even more critical when issuers have negative cash flows from operations, negative working capital position, or a deteriorating financial position, because this disclosure is intended to help the users to assess how the issuer will meet its long and short-term obligations and objectives. For discussion relating to results of operations, the observation was that some issuers just provided a boilerplate disclosure and repeated the financial statement information and disclosure. The discussion of the year-over-year change of balances should really provide sufficient detail to discuss key drivers and reasons contributing to the change for the period. Trends, commitments, risks, and uncertainties that will impact the company should be discussed. Forward-looking information, non-GAAP measures, as in the past couple of years, failures of such disclosures in this area came up again as a hot button for the CSA staff in their reviews. Seems that companies that use forward-looking information and non-GAAP measures in their continuous disclosure documents have not clearly identified them as such and/or included the appropriate disclosures that go with this type of information. The concern from the staff here is that the users may be misled if the disclosures are not provided as required by the rules in National Instrument 51102, as well as CSA Staff Notice 52306. REIT distributions came up as a hot button this year as it was noted that some REITs declare distributions which exceed the cash they generate from their operations, but do not provide the relevant disclosures in the MD&A and their AIF. The disclosure is required to signal to the investor that excess distributions have occurred during the period, as well as information on how they were financed and that they represented a return of capital, amongst other things. The CSA emphasized that this is important to alert the investors so that they are not misled in such circumstances. In their review of related party transactions, they observed that some issuers provided a boilerplate disclosure which is not useful to the users. Rather, they remind issuers that the discussion should really provide both qualitative and quantitative information that is necessary for the readers to understand the business purpose and economic substance of such transaction. I will go through the last point presented here relating to the staff's findings relating to management certifications on the next slide. The staff this year discussed in some great detail the certification disclosures and their findings. The requirement around certification disclosures are included in NI 52-109 and requires issuers to file certificates of annual and interim filings signed by an issuer's CEO and CFO. Non-venture issuers are required to design or have caused to be designed DCNP, which is Disclosure Controls and Procedures, and ICFR, Internal Controls over Financial Reporting, on an annual basis, and on an annual basis evaluated or caused to be evaluated under their supervision the effectiveness of DCNP and ICFR. The issuer is also required to disclose in its annual MD&A the CEO and CFO's conclusion about the effectiveness of DCNP and ICFR. When the certifying officers determine that there is a material weakness relating to the design or operations of ICFR, or when there has been a limitation on the scope of the design, issuers must include certain information as dictated by form requirements in National Instrument 52-109 in their certification, as well as including disclosure in the MD&A describing the material weakness or summary financial information relating to the entities subject to the scope limitation. Upon their CD reviews, they've identified 3 common areas of deficiencies. First, they found that there were inconsistencies between the certificate and the MD&A disclosure. For example, where they've indicated on the certificate that there was a material weakness, there was no discussion in the MD&A of the material weakness. Secondly, material weakness disclosure. For instance, some issuers did not describe the material weakness in sufficient detail. Rather, it was vague and gave little insight about the impact of the issuer's financial reporting. It was also noted that certain issuers reported material weakness for a number of consecutive years, and during that time had experienced significant growth in their operations. Although remediation of an identified material weakness is not required under the rules, it would be useful to an investor if the issuer discussed whether they have committed or will commit to a plan to remediate the material weakness, and whether there are any mitigating procedures that reduce the risks that have not been addressed as a result of identified material weakness. There is further discussion of such in the Companion Policy 52-109, Section 9.7, so issuers are reminded to refer to the policy when this is applicable. They also remind issuers that a meaningful discussion of an unremediated material weakness should be updated in each MD&A to ensure that the impact of the material weakness continues to be properly reflected as the company grows or goes through other changes in their operation. This will be further discussed using an example in the next slide. Thirdly, they found that the limitation on scope of design relating to an acquired business was not disclosed sufficiently. Staff noted that certain issuers had a scope limitation relating to two or more unrelated entities but presented combined financial information instead of disclosing information for each entity separately. They encourage issuers to refer to Section 14.2 of 52109 CP, which permits presenting of combined financial information only when the businesses are related. As discussed on the previous slide, this is an example of a deficient disclosure relating to a material weakness. I won't read off the entire slide for you, but the illustration is given to re-emphasize some deficiencies relating to the description of the material weakness, the impact of the material weakness on the issuer's financial reporting and its ICFR, and whether the issuer's plans, if any, to remediate. More specifically, in this example, there is a reference to more than one internal control deficiencies in one place, but in the actual discussion of the deficiency, they only describe one, a lack of segregation of duties. And there is also a lack of a clear identification that this is a material weakness. Also in this example, they referred to financial matters, but the meaning of such term used in the description of the deficiency relating to segregation of duties is unclear and insufficient. Findings from the CSA's continuous disclosure reviews included other regulatory disclosure deficiencies. These were the 5 that's pointed out here in the bubbles on the slide. With material contracts going from left to right, the staff mainly reminds issuers that there is a list of contracts given in National Instrument 51102 that must be filed even if the contracts are entered into in the ordinary course of business. Material change reports were noted as sometimes not being filed on time, which is within the 10 days of the date of change or as soon as practicable. It was also noted that issuers should be mindful that these announcements should be factual and balanced, and unfavorable news must be disclosed just as promptly and completely as favorable news. Selective disclosure was noted in the report as a hot button also, as it appears that certain issuers disclose material non-public information to one or more individuals or companies and not broadly to the investing public. Once again, mineral projects as it relates to disclosures that is required in National Instrument 43101 standard of disclosure for mineral projects was noted as a deficient area, as well as filings of news release was mentioned in the report as the staff continued to see unbalanced and promotional disclosure. Issuers are reminded to refer to guidance on best disclosure practices in National Policy 51201 as well as Form 51102 F1 Part 1A. Now we can move on to some detailed look at the common deficiencies that were identified in the full reviews as well as IORs that relate to financial statements. This, of course, is not an exhaustive list of disclosure deficiencies that the CSA noted in their reviews. They reminded issuers that they are required to ensure that their continuous disclosure record complies with all relevant securities legislation and that the volume does not always equate to full compliance. In the notice, the CSA outlined 3 hot buttons and a disclosure example to illustrate financial statement deficiencies. These were in the areas of operating segments, business combinations, fair value measurements, and impairment of assets. Now we will look at these individually in more detail in the following slides with my colleague in the National Accounting Group, Claire Grinley. First, we will visit the deficiencies noted relating to operating segments. The 2 observations that were pointed out by the regulators here was that there were failures to disclose the appropriate information on geographic areas as well as major customers, where appropriate. Claire, with respect to these findings, can you explain the IFRS requirements on disclosures in these areas?
Yes, I can, Julia. There's two paragraphs that are the focus of the CSA comments, and they're paragraphs 33 and 34 of IFRS 8. Paragraph 33 deals with disclosures for revenues and for non-current assets by geographical area. And the intent of this disclosure is to assist users in understanding the risk concentration within the entity as a whole. For both external revenues and non-current assets, an entity is required under IFRS 8 to show each amount for the country of domicile as well as for all foreign countries in aggregate. In addition, if a balance in an individual foreign country is material, then this must be disclosed separately. Paragraph 34 deals with disclosure of information about major customers, because major customers of an enterprise represent a significant risk concentration. And under paragraph 34, if revenues from a single external customer amount to 10% or more of an entity's revenues, then this fact must be disclosed along with the total revenues for that customer and the segment to which the revenues relate. There is, however, no requirement to disclose the identity of the major customer. So let's take a look at how that might work in practice with an example disclosure. And we've got one here, and you can see that you've got the group that operates in two areas, Canada, and that's a country of domicile in this case, and the UK. And then we've got some narrative and then a table. And as you can see, both for the current year and the prior year, for Canada and for the UK, you can see the revenue from external customers and also the non-current assets. Now, in this case, we've just got the country of domicile, Canada, and one foreign jurisdiction being the UK. If, say, we had a third foreign country or a second foreign country, so we had UK and France, an entity would be permitted to just show the aggregate revenue and non-current assets for those foreign countries, unless one of those foreign countries was individually material. Then immediately below the table, we've got information about major customers. And as you can see in this case, we do have one major customer that contributed to 10% or more of the group's revenue for both years, for 2015 and 2014. So here we've disclosed what that amount is, but as I noted just now, no requirement to disclose the identity of the customer itself.
Claire, I know that the ISB completed a post-implementation review of IFRS 8 a couple of years ago. Were there any findings from that review that coincide with the results of the CSA review here?
You're right, Julia. There was a post-implementation review, but there wasn't a lot here that was commented with respect to geographical information or major customers being the subject of the CSA's comments this year. However, there were a number of other findings from that review, and there are going to be some changes in IFRS 8 in other areas. And in fact, an exposure draft is currently being drafted to address the proposed amendments, and we expect to see something from the ISB in the next 6 months.
Okay, the next hot button that was listed in the staff notice this year related to business combinations. It seemed that when companies had acquired a business, it was unclear to the staff as to whether the issuers have appropriately assessed the purchased business to separately identify intangible assets such as customer lists, intellectual properties, etc. Claire, can you tell us in some detail as to what the IFRS requirements are that relate to the deficiencies noted by CSA, and what does IFRS 3 say?
Yeah, so the paragraphs that the CSA focused on were 10 to 13, 45, and Appendix B of IFRS 3. But at the heart of the CSA's comment is a requirement under IFRS 3 to do a purchase price allocation at the date of acquisition. And that effectively takes the total purchase price and allocates this out to all the assets and liabilities that have been acquired. And this process requires an entity, the acquiring entity, to recognize the identifiable assets acquired, including intangible assets. And there could be a whole host of intangibles that meet the criteria for recognition as a separate asset. And it is important for entities who are in acquiring activities to perform a complete search for all intangibles and separately recognize them. There is some temptation perhaps to shortcut the process and just leave all of the residual purchase price in goodwill, but this isn't in compliance with IFRS 3. And remember also that goodwill is not amortized, and most intangibles, save indefinite life intangibles, are amortized, and as such the failure to properly identify all intangibles will have a direct impact on post-acquisition performance. Now, IFRS 3 it does allow some time to complete this purchase price allocation in case entities, are listening and thinking, well, that's quite a lot of effort that might be involved there. And they're right, it is. But a measurement period of up to 1 year is permitted for an acquiring entity to obtain information about facts and circumstances that existed at the acquisition date. And until the purchase price allocation is finalised, provisional amounts are reported in the financial statements. But if the amounts change when we actually finalise and close the purchase price allocation, adjustments have to be made, and they have to be made to comparative periods previously presented as well. And this might include, say, if you've reallocated maybe 100 million from goodwill to an amortised and intangible, you wouldn't just do that reallocation. You'd also have to record any catch-up amortization for that time period. To illustrate what I've been saying a little more, we've got a before and after picture here, a kind of IFRS 3 makeover. So let's look at the transaction before an entity has considered the IFRS 3 requirements appropriately. And here you can see you've got a total purchase price of $700 million, but we have actually, in this case, identified no intangible assets, and any excess purchase price has just been allocated to goodwill. It's got a pretty sizable goodwill balance there of $465 million. However, on the right-hand side of the screen, the entity has seen the light, and indeed here we've actually got $300 million of intangible assets separately recognized in the form of licenses, patents, and customers lists. So goodwill diminishes from $465 million to $165 million. And that's a very simple example, but that quite succinctly illustrates the point the CSA is making. We'd just like to note here as well that this is not a new one. IFRS 3 has been around for a while, and this has been a recurring comment that we've seen in practice from regulators and elsewhere. So clearly some entities are still struggling with this aspect of IFRS 3. So perhaps it's time to just take a refresher of the requirements.
Thanks, Claire. Now, the next topic was fair value measurement observation. Here we have the discussion in the notice where the staff of the CSA continues to see issuers that fail to disclose a description of the valuation technique and inputs used for fair value measurements categorized within level 3 of the fair value hierarchy. Claire, can you please discuss with us what the specific requirements are in IFRS 13 and what the CSA is expecting to see here?
Yeah, and IFRS 13, unlike IFRS 3, is a newer area, and it is a very complex standard that is pervasive to the financial statements of an entity. Perhaps before I just explain the requirements that the CSA is focusing on, it might be just helpful to review the fair value hierarchy in IFRS 13. And if we think about level 1, items, these are unadjusted quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. So quoted prices in active markets. Level 2 refers to a fair value measurement that includes inputs other than quoted prices within level 1, but nonetheless those inputs are observable for the asset or liability in question. Level 3, however, valuations rely on unobservable inputs and may include also the entity's own data. So certainly it's unsurprising that the standard setters require an additional degree of disclosure for a fair value measurement that's level 3 in nature versus level 1 and level 2. And indeed, that's exactly what the CSA has picked up on. The IFRS 13 requires more disclosure for level 3 items, but some entities are failing to provide that disclosure in their financial statements. I'll go through a few of the items in the grey shaded box that we've shown on the screen here, but would caution people to take a proper review of paragraphs 93D to 93H, and there you can see more fully all of the disclosure requirements relating to level 3 items. The first one relates to, on the screen here, relates to recurring and non-recurring fair value measurements in both level 2 and level 3. And here there is a requirement to give a description of the valuation technique, the inputs used, any change in these, and the reasons for the change. The next item on the screen relates to recurring fair value measurements in level 3. And here there's a requirement to do a reconciliation from the opening balances to the closing balances, disclosing details of any changes. Disclosure of the amount of the total gains or losses for the period included in profit or loss and attributable to the change in unrealized gains or losses, and then also a narrative description of the sensitivity of the fair value measurement to changes in unobservable inputs and a description of interrelationships with other inputs. So quite a bit of disclosure there that IFRS 13 requires entities to provide to users. Lastly, on this slide, for both recurring and non-recurring fair value measurements in level 3, there is a requirement to provide quantitative information about the significant unobservable inputs used in the fair value measurement, and lastly, a description of the valuation processes used to decide valuation policies and procedures. So quite a lot there, and I have to take a bit of a deep breath just in thinking about all that, but perhaps if we move to the next slide, you can see how some of that is put into practice with an example that we've provided. And what I would say here is I know some entities make use of Deloitte's checklist or other checklists for financial statements, and some entities choose not to do that. But what I would recommend that for IFRS 13 in particular, it is really easy to miss some of the disclosure requirements. There are a lot of them, so would recommend you make reference to a checklist or speak to your Deloitte advisor when you're reviewing the completeness of your IFRS 13 disclosure requirements. Here on this table you can see two items, level 1 and level 3, and really we've included these here to show the contrast of the additional information that's required for the level 3 item, the privately held equity securities, in contrast to the level 1 fair value item. And you can see for the level 3 item we've got a description of the valuation techniques and the key inputs. And then if we move along that table, we've got details of the significant unobservable inputs, and here got a description of each one, so a narrative description, as well as the quantitative amount as well. So for example, for long-term pre-tax operating margin, which is one of the significant unobservable inputs, you can see that it's from 5 to 12%. Lastly, we've got the sensitivity piece in the far right column of the table, and here there's a description of how what the relationships are between the different inputs and what happens to the fair value measurements in the instance where one or more of those inputs changes.
Okay, so the impairment of assets continues to be an area of deficiency once again. This was an area noted in last year's staff notice, and it was discussed that there was a deficiency noted where issuers failed to disclose how the loss amount was determined. The same deficiency was noted once again this year. In addition, there were also failures to use appropriate cash flow projections when the recoverable amount of an asset or the cash generating unit was value in use, and also that some did not disclose the significant judgments and the uncertainties involved in estimating the recoverable amount of the asset or the CGUs. Claire, can you elaborate as to what the requirements under IFRS are? I believe there are multiple IFRS disclosure requirements that come into play here.
Yeah, there are indeed, Julia, and as you know, the CSA decided to give reporting issuers a reminder in this area, and it does appear to be a recurring area of focus. In their report, they actually focused on some of the measurement requirements as well as disclosure, and just reminding people that if you're doing a value in use calculation under IAS 36, that the cash flow projections have to be based on reasonable and supportable assumptions. And also, to the extent that you're using a budget forecast as the standard requires in order to do that valuation in use calculation, there is a comment in a report that must be cognizant of the fact that there is a maximum of 5 years that it's anticipated that an entity can forecast out for, and you can only use a longer period if an entity is able to justify that. And in some unusual situations, an entity might be able to justify it based on past experience and a demonstrated track record of reliability in forecasting, but it would be unusual for an entity to be able to reliably forecast beyond a 5-year period. So generally some form of extrapolation is required. From a disclosure perspective, the CSA commented on the requirements of paragraph 130 of IS 36, which requires that these items are required to be disclosed when an impairment loss is recognized or when an impairment loss is reversed. Firstly, the events and circumstances that led to recognition or reversal of the impairment loss. Secondly, the amount of the impairment loss recognized or reversed. Then, when an asset is tested for impairment on a standalone basis, the nature of the asset and also the reportable segment to which that asset belongs. Where an asset is tested for impairment as part of a CGU, then a requirement to give a description of the CGU, the amount of the impairment loss recognized or reversed by class of asset. And then lastly, if you recall, recoverable amount is based on either fair value less cost of disposal, which is an IFRS 13 based measure, or value in use. And depending on what recoverable amount calculation is used to calculate the impairment, then the disclosure requirements differ. Firstly, if it's fair value less cost of disposal, then there is a requirement to disclose the level of the fair value hierarchy, just what we've talked about in IFRS 13, that the measurement relates to. And if it's level 2 or level 3, then a description of the valuation techniques used. And lastly, on this slide, if value in use is used to determine a recoverable amount, then there's a requirement to disclose the discount rate used in the current period as well as in any previous estimate of impairment. So I think, Julia, the CSA included in their report some disclosure of what was bad disclosure and what was good disclosure for IS 36.
Yes, Claire. So now that you've gone over what the requirements are under IFRS 36, let's look at this example. The deficient example appears to be quite light, as you can see, and the deficiencies include a lack of disclosure of how it measured the recoverable amount of property Y, and the associated judgments and estimation uncertainty, including whether the recoverable amount was value in use or fair value less cost of disposal. And if the recoverable amount was value in use, the discount rate used in the current and previous estimate of the value in use, which is required by IS 36, paragraph 130G. Or if the recoverable amount was fair value less cost of disposal, the applicable level of fair value hierarchy, and in the case of level 2 or 3 of the hierarchy, the valuation technique and the key assumptions used as required by paragraph 130F. And of course, the judgments made and the uncertainties involved in estimating the recoverable amount of the property as required by paragraph 125 of IS1. In contrast, the bottom example, which is a good example of the disclosure, is much more detailed and provides the disclosures that is required by the two standard IS 36 and IS1.
So on this slide here, we've just shown some reminders relating to IS 36. I'll go through it quickly now, but really just wanted to reinforce some of the key requirements of 36. Nothing new again, but ones that perhaps need some refreshers for when applying in practice. So in terms of IS 36, some assets are tested for impairment on an annual basis, and that's goodwill. But then for all other CGUs and assets, there is a requirement to assess at the end of each reporting period whether there are any indicators of impairment. And IS 36 includes a lot of guidance as to how you assess for indicators of impairment as well as for reverse indicators. And if there is an indication of impairment, then there is a requirement then to estimate the recoverable amount, and that's based on the higher of the fair value less cost of disposal and value in use. Now, when you have an impairment, there is a requirement to disclose whether or not the recoverable amount is fair value less cost of disposal or value in use. And then I'm not going to go through the next couple of comments we've got on the slide here because it's just reiterating the comments that I made on the previous slide. But if you look at paragraph 130, it'll set those out in detail for you. Again, the value in use comment on this slide is just a reminder about the restrictions regarding cash flow projections and making sure entities adhere to those restrictions. Last point that we've got in this slide refers to paragraph 109 through 123 of 136 of IAS 36, and this is just a reminder that there is a requirement to assess for reverse impairment indicators as well as for impairment indicators. On the next slide, we've got IFRS 6, and this is just a refresher as well, and a reminder that the impairment process for IFRS 6 is slightly different to IAS 36, and there are specific indicators that are listed for entities who are within the scope of IFRS 6. Impairment is required to be assessed under IFRS 6 when facts or circumstances suggest that the carrying amount may exceed the recoverable amount. And then what IFRS 6 does is go on to list specific impairment indicators that would be relevant for an entity within the scope of IFRS 6. So, for example, does the right to explore expire? Is there a plan to discontinue any further expenditures relating to the exploration activity? Are we at a point in time where there's been no discovery of commercially viable mineral resources, or is there some kind of other information that indicates that the carrying amount of the E&E asset is unlikely to be recovered through development or sale? We've also noted here market cap considerations as well, noting that market cap is not an impairment indicator that's specifically listed under IFRS 6, but this could indicate that other impairment triggers may exist. So if your market cap has fallen underwater, then that could be an indication that you've got some other impairment triggers that are causing that market cap to go underwater. There was a useful IDG discussion on this. That's the IFRS discussion group on this a year or two ago, where the group discussed it at length, the impact of market capitalization on impairment for E&E entities. And if anybody has trouble finding that discussion, which was public and for which minutes were available, then feel free to contact any of the Deloitte team and we can certainly point you in that direction. So we're going to move away now from CSA and look at some other developments in the IFRS world. So things that are changing, things that are coming up in the future. And the first section is focus on, and it's IFRS 15, revenue from contracts with customers. Now, the summer months were pretty busy months as it related to IFRS 15, revenue from contracts with customers. You might recall that the standard as originally issued had a mandatory effective date of January 1st, 2017. However, subsequent to the issuance of the standard, the ISB and the FASB formed a joint transition resource group for revenue recognition, referred to as a TRG, and this was designed to support the implementation of the new standards. And as a result of the ongoing discussions of the TRG, a number of targeted amendments to the new revenue standard have been discussed and approved, and I'll talk through some of those on the next slide. However, in light of all this activity and these proposed amendments, concerns were raised about the broad impact of the new standard, and the boards, both the ISB and the FASB, began to receive unsolicited comment letters from stakeholders requesting a one-year deferral. And so as a result, the ISB took note of this, as did the FASB, and in its July 22nd meeting, the ISB formally approved the deferral of IFRS 15 to January 1st, 2018, with earlier applications still being permitted. The ISB finalised this amendment on September the 11th, 2015, and this amendment is now published. It's important to remember also that this standard is generally converged with US GAAP, and the equivalent US GAAP topic is 606. And earlier in July, the FASB also approved a one-year deferral of their revenue standard. Now, as I mentioned, some proposed targeted amendments were expected to be made to IFRS 15, and in late July of this year, the ISB issued an exposure draft on these proposed amendments. And the amendments include clarifications to the following topics: identifying performance obligations, principal versus agent considerations, licensing and a right to use versus a right to access, and practical expedience on transition. I should also note here that there are some differences between the approaches taken by the ISB and the FASB in addressing these proposed amendments. Now, comments are due on this exposure draft by October the 28th of 2015, but I'm not going to talk about them anymore here because we do actually have a revenue focused webcast on October the 21st that will discuss these amendments in a lot more depth. So we hope very much that you can join us for this webcast and find out more about these areas. So looking ahead, going to look at one exposure draft that the ISB have issued for which a comment period expires soon, and then in our usual along with the usual tradition in webcasts, look at the ISB project plan. So firstly, the exposure draft on IAS 19 and IFRIC 14. So this deals with two areas actually, so it's quite a meaty exposure draft. It deals with remeasurements following a significant event, and I'll talk to that in a few seconds. But firstly, I wanted to talk about the IFRIC 14 amendment, and that relates to the refund of a surplus from a defined benefit plan. Now, the proposed amendments to IFRIC 14 are related to the asset ceiling test that we've got in IAS 19, which limits the extent of any surplus that can be recognised. And effectively, a surplus can only be recognised to the extent that the surplus can be recovered through a refund back to the entity or through a reduction in future contributions. And the proposals deal with the former of these items, the right to a refund, and whether or not it is unconditional and therefore available to the entity. Now, under the proposals, where trustees are able to enhance benefits without the consent of the entity, then a right to refund is not considered to be unconditional under the proposals. Conversely, the ability of plan trustees to purchase annuities as plan assets or make other kinds of investment decisions does not impact the availability of a refund. This won't really be a common issue in Canada because on the one hand, many plans don't operate at a surplus, and also when we do look at recoverability, generally we're able to find this is supported through reduced future contributions and not through a refund of contributions. However, it may be relevant to some entities, hence we wanted to update you of this change or proposed change. The second part of the amendments deals with IAS 19 and remeasurements, and it relates to the accounting treatment when you have a significant event such as a plan amendment, a settlement or curtailment, and how the accounting works in that scenario. So I'm going to go through what the proposals are on this slide. Got three main points to be made here, noting that some of these are in the standard already today, but the wording is going to be clarified, but one of the items specifically is not addressed in the standard as it stands today, and would, if it goes through, have a significant impact on, or could have a significant impact on profit or loss for entities entering into these types of transactions. So firstly, if you've got a plan amendment or a curtailment or a settlement, then immediately before that event occurs, there is a requirement to update the amounts and the assumptions. So for example, if in the middle of the year you decide to settle part of your plan, then the discount rate might have moved between the start of the year and the date of that settlement. So you would remeasure the obligation based on the new discount rate. Similarly, there might be other changes, for example, the returns on plan assets during that period. So immediately before the event, you would recognize a remeasurement that goes through other comprehensive income to reflect these updated assumptions. Then after that event, you're required to remeasure the net defined benefit liability or asset so as to reflect the benefits offered after the plan amendment, curtailment or settlement. And this part of the change is recorded in profit or loss, and it's either a settlement gain or loss or past service cost. And that effectively shows to the users of the financial statements how the obligation has changed as a result of this transaction. The third item is the significant new item that the proposals are focusing on, and this relates to net interest and current service cost. So ordinarily speaking, net interest and current service cost are based on financial assumptions and demographic assumptions as at the start of the year. But what the proposals require is that if you have a remeasurement event, then you look at your new assumptions as of the date of the remeasurement, and for the period subsequent to the remeasurement event, you update your assumptions that you employ in net interest and current service cost. So for example, if at the start of the year the discount rate was, I don't know, 4.5%, and if mid-year that changes to 5%, and mid-year is when you have your remeasurement event, net interest and current service cost for that post-event period would be based on a discount rate of 5% and not 4.5%. It's always good to have a visual to illustrate these sorts of things. So let's look at the next slide where we've got that. Even got some color in there as well, and here you can see got a calendar year end entity. January 1st is when they would initially set the actuarial assumptions that are employed to determine current service costs and net interest costs for the year, and in ordinary situations those would flow through and be applied throughout the year. But under the proposals, if say on June the 1st or any other date in the year you have some kind of plan amendment, curtailment or settlement, then current service and net interest in the period subsequent to that event would be based on the actuarial assumptions as at the date of the plan amendment. And as I said before, that would have a direct impact on profit or loss. Now, the exposure draft is out for comment at the moment, and we have included a link to that on the preceding slide. So if anybody is interested in commenting or reading more about the proposals, then you might want to take a look at that link. So that's what exposure drafts have been issued at present, or the ones that we thought would be of interest to you in this webcast. But what's on the horizon for the future? Well, if we take a look at the IASB's latest work plan, there's quite a few other things that are in the works here. The one that really stands out is, of course, the proposals for the new leasing standard, and we do actually expect to see a new leasing standard before the end of the calendar year. Well, I know that many people have been waiting for this one, but perhaps not waiting eagerly for this one, because this will fundamentally change lease accounting as we know it today, and this is a new standard that's been a topic of a significant amount of research as well as a lot of debate, so it will be interesting to see the culmination of the efforts here in the months to come, and I'm sure once that new standard is issued we'll be talking about it a lot more in our webcast of the future. Before that, a couple of items I'd like to focus on, though, are some draft IFRIC interpretations that you may or may not be aware of. The first one relates to uncertainties in income taxes. So this is your uncertain income tax positions, for which there's been a bit of a vacuum of guidance, or a lack of IFRS guidance on this in the past. We expect within the next month or so to see an interpretation which will address how uncertain income tax positions are going to be recognized and measured. The second draft IFRS interpretation that we expect to see relates to foreign currency transactions and advance consideration. And this might be a case where you enter into a sale and it's a foreign currency transaction, and the cash consideration is received before the point in time at which the revenue can be recognized. And what this draft interpretation is proposing to address is what's the appropriate exchange rate to be used. Is it the exchange rate at when the cash consideration is received, or is it the exchange rate that's in place when the revenue is actually able to be recognized? And I think that's probably good enough for now. There's obviously a number of items that are in the works that I haven't touched upon here, but you can access the ISB work plan directly yourself if you'd like to find out more about those. So I think on that note, John, I will hand it back to you.
Okay, thanks, Claire, and thank you, Julia. Julia, we have a question here for you. Earlier in the presentation, you highlighted some disclosure deficiencies related to IFRS 8. Are there any new requirements on operating segments that we might expect to see the CSA focus on in the review next year?
Yes, John. The amendment to IFRS 8 regarding the additional disclosures are effective for annual periods on or after July 1, 2014. And these amendments relate to the disclosures of aggregation of operating segments, where entities are also required to disclose the judgments made in applying the aggregation criteria in IFRS 8 paragraph 12, so the description of the operating segments aggregated and assessments of similar economic characteristics. And also the new requirement is the disclosure to provide a reconciliation of the total of the reportable segment's assets to the entity's total assets only if the amount is regularly provided to the CODM, which is the chief operating decision maker.
Great, thanks, Julia. We're pleased to introduce Deloitte Canada's Centre for Financial Reporting, or CFR, website. The CFR features an extensive collection of news and resources about accounting and financial reporting developments relevant to the Canadian marketplace. Our site is easy to use and intuitive. You can find the link to the website at the bottom of your screen, so please be sure to check it out. Thanks again to our speakers, Julia Suk and Claire Grindley. I'd also like to thank our behind-the-scenes team, Nura Tayev, Kieran Kular, Elise Beckles, and Alan Kirkpatrick. We hope you found this webcast helpful and informative. If you have any questions or feedback, you can reach out to your Deloitte partner or other Deloitte contact. And if you'd like additional information, please visit our website at www.deloitte.ca. And to all of you viewing our webcast, thank you for joining us. This concludes our webcast, bringing clarity to an IFRS world, IFRS Quarterly Technical Update.